So there are some common approaches to pricing. Paul mentioned what is probably the most common, random or accidental pricing. And I would say that this occurs in somewhere from 50 to 70% of SaaS companies. So if this is where you find yourself, don't worry, you're not alone. A lot of people start there. However, there's nothing good about this approach to pricing. And the reason for that is it's very hard to improve something that's random. And pricing needs to be adaptive and improve as constantly be adapting to the market as it changes. Another common approach is cost plus, where you understand your costs and you add your target margin, and that gives you your price. The good thing about this is it can protect your margin. The problem is, though, that it leaves a lot of money on the table, and unless you are the low-cost provider in your industry, it's a failing strategy. And the reason for that, of course, is your competitors. So some people price relative to a competitor. They price a little bit higher or lower than the major alternatives in the market. This is a good start. Being focused on competitors really improves your market awareness, and that's a critical success factor in pricing. The problem, though, is that it allows competitors to control the conversation and to define the terms on which you're going to compete, which is not really a successful long-term strategy. So the next thing that people do is they price based on their customers' willingness to pay, or as pricing people love to say, WTP. This is also a really good approach because it gets you listening to customers, and that's critical. Any pricing conversation should be a conversation about value, and you can only understand value by listening to your customers. The problem with pricing based on willingness to pay is that it allows customers to control the conversation. And in the real world, willingness to pay is something that you can shape. And the way that you shape it is with value-based pricing. And there are many studies showing that value-based pricing is the best way to optimize, either for revenue growth or for profit, or to find the right balance between the two. The downside of value-based pricing is it's more complex. You're going to need to invest in really understanding your customers, tracking your competitors. You're going to need a value model, a formal value model of how you're creating value for your customers. And you're going to need to monitor this over time. So it does require more effort or more investment. But if you can make that, that's what will have the biggest impact.